supermicrocomputer is still at the center of AI infrastructure. The guidance is still there, but the stock has been absolutely destroyed. This isn't about AI demand. It's about something most investors are missing. Hey everyone, this is Deep Dive Stock Earnings. Today we're talking about SMCI. A lot of investors are confused right now. On one side, the AI server story, compute demand, and GPU supply chain narrative are all still alive. On the other side, the stock has fallen from the mid-60s down to the low 30s, almost a straight 50% drawdown. In this episode, I'm not here to talk about emotions or hype. I want to break down, step by step, the real logic between the earnings and the stock's price reaction. Let's start by getting the earnings straight, because the biggest misunderstanding around SMCI right now comes from only looking at half the data. Here's the bottom line first. SMCI's problem is not whether it can sell products. The issue is that the more it sells, the more pressure shows up on the balance sheet. In the most recent quarter, revenue remained very high, and the company's forward guidance is still aggressive compared to most of the hardware industry. AI server demand hasn't disappeared, and orders haven't suddenly collapsed. What has changed is the financial structure. When you look at the earnings in detail, one signal stands out very clearly. Working capital is tightening, inventory has risen noticeably, accounts receivable are stretching out, and the cash conversion cycle continues to deteriorate. On the surface, this looks like preparation for AI server orders, but on the financial statements, it means cash is being tied up aggressively. More importantly, free cash flow has declined sharply, and that is something institutional investors are extremely sensitive to. For hardware companies, if revenue growth comes from piling up inventory and locking up cash, the valuation framework changes immediately. That's why you see such a contradictory situation. SMCI's revenue guidance still sounds very strong, yet the market is no longer willing to pay an AI premium for the stock. It's not because AI doesn't matter. It's because the growth path the company is showing is becoming more capital intensive and much more demanding on cash flow resilience. So right now, the real question isn't whether AI still works. AI demand is clearly still there. The question is whether this specific AI growth path is worth betting on at today's price. In other words, is this growth building a solid foundation for the future, or is it pulling too much cash and patience forward? That's where the market is hesitating. And that directly explains why the stock's reaction has been so cold, and frankly, so aggressive. The market isn't denying SMCI's role in AI infrastructure. What it's doing is relabeling the company. In the past, SMCI looked more like a fast-turning, relatively asset-light server manufacturer that competed on efficiency. Now, it increasingly looks like a heavy asset hardware business that must absorb inventory risk and supply chain pressure. If you look at the sell-off alongside trading volume, the signal is very clear. The sharp down moves have consistently come with above-average volume. That kind of action is usually not retail panic selling. It looks much more like staged institutional risk reduction. Once key technical levels were broken, capital that had been hoping for support in the low 30s was forced to stop out, and once that selling pressure starts, it's very hard to repair quickly with short-term bounces. At the same time, 3F data shows a subtle but important contrast. Overall institutional ownership remains high, which means the company hasn't been abandoned, but some hedge funds are reducing equity exposure while increasing downside protection through options. The combination reflects caution toward near-term risk-reward. In simple terms, institutions aren't saying SMCI is finished. They're saying right now, the risk is not on the long side. There's another important shift here that often gets overlooked, and it directly affects margins. Historically, SMCI's biggest advantage was speed and flexibility. It didn't design its own chips. Instead, it built around NVIDIA and AMD platforms, rapidly integrating server solutions for customers. When demand spiked, SMCI could respond faster than many traditional vendors. But when AI servers move from scattered deployments to long-term, large-scale delivery, the dynamics change. Customers start demanding larger volumes, more stable delivery schedules, and tougher pricing terms. That naturally compresses margins and magnifies inventory and cash flow pressure. At that stage, growth is no longer just about speed. It becomes a test of execution and financial endurance. This is why the market's hesitation isn't about whether SMCI can grow revenue. It's about whether this growth model can continue without sacrificing too much quality. And that's why the stock is being held down rather than repriced upward. And because of that, you can't just look at the story anymore. You have to look at price structure and capital behavior together. Money doesn't speak in narratives, it speaks through price, and right now, price is telling you exactly how institutions feel. From a technical perspective, SMCI's chart is very textbook. After a rapid run-up, the stock entered a high volatility downtrend. Each rebound is weaker than the last, and each push lower comes with expanding volume. For anyone who trades structure, that sends one clear message. The trend is no longer controlled by the bulls. The psychological impact is just as important. A large amount of capital entered around the 50 to 60 range and is now deeply underwater. That creates the natural outcomes. First, any rebound attracts selling from investors trying to get out. Second, the market starts to distrust good news instead of chasing it. That's why even positive AI-related headlines now generate very muted price reactions. Then there's another factor that becomes critical at this stage: insider activity. Over the past few months, insiders at SMCI have been consistently selling. This doesn't automatically mean fundamentals are broken, but in an environment where trust has already weakened, the market amplifies this signal and uses it as a psychological anchor that weighs on valuation. So SMCI is now in a phase where the story isn't broken, but patience is exhausted. The AI narrative still exists, but capital now demands execution, cash flow discipline, and efficiency in bigger stories. Looking ahead, what exactly does the market need to see to regain confidence in SMCI? The answer isn't complicated, and it doesn't require a new narrative. Investors want to see inventory begin to unwind instead of continuing to build. They want to see receivables convert back into cash, not just sit in contracts and guidance, and they want margins to at least stabilize instead of continuing to slide. These signals may sound boring, but to capital, they matter far more than any AI headline. Once these metrics begin to turn, the market will start to view the recent pressure as temporary rather than structural. Until then, SMCI is unlikely to become a sentiment-driven stock again, but when those indicators do shift, price reactions are rarely gentle. So if we compress everything into one sentence, it's this: SMCI hasn't been abandoned by the AI narrative. It's being repriced based on execution cost. Until rapid growth converts into healthy, sustainable cash flow, the stock won't regain its former premium in the short term. That's pressure in the long term. It's a dividing line. This is Deep Dive Stock Earnings. I'll see you next time.